$1 trillion vanished into thin air. Not because of war, nor due to a pandemic or a market crash like in 2008, but because of a single decision, unannounced, unexplained, and without warning from Beijing. No shots were fired. No tweets from world leaders. Just a cold, quiet silence, like a steel door slowly shutting in the middle of the night. And then the next morning, executives in New York, San Francisco, and Chicago suddenly realized the capital from China, once the lifeblood of their financial systems, was gone. No one knew exactly what had happened, but the numbers started turning red. Stocks tumbled, projects were put on hold, and the financial world spun into confusion, blindsided by an invisible but razor-sharp blow. Because this wasn't an accident, it was a message. A deliberate first strike from Beijing, signaling that the US-China conflict had entered a new phase. No longer just about tariffs, no longer just about semiconductors, but about money, about capital, and about the flow of global power. But what really happened behind the scenes? Why did China choose this moment to freeze? And what is quietly shifting behind the red brick walls of Beijing? The answer begins with an almost invisible development, noticed only by the sharpest eyes in the investment world, where a tiny policy change could ignite a financial geopolitical battlefield more intense than any war we've seen before. In March 2025, just as global financial markets seemed to be stabilizing after the previous year's turmoil, China's Ministry of Commerce quietly updated what appeared to be a harmless technical document. No press conference, no media coverage. But buried within it was a short line of text. All outbound investments, unless deemed essential, and especially those directed toward countries with high geopolitical risk, would be suspended indefinitely. It was Beijing's cold, calculated way of issuing an order. Lock the wallet, especially when it comes to America. Just a few days later, on March 17th, a classified memo from China's State Administration of Foreign Exchange was delivered to major banks. The message was brief but firm. Suspend all investments into the United States. No exceptions, no extensions, no special arrangements. The order was signed, transmitted, and then vanished from public systems, as if it had never existed. But the market didn't need an official announcement. They could smell it. Financial reports from Chinese investment funds were suddenly delayed. M&A deals were abruptly marked as pending reevaluation. And when Reuters first confirmed the news through anonymous sources, global investors immediately understood this wasn't just a routine policy tweak. According to data from the Rhodium Group, Chinese direct investment into the US had already fallen from $46 billion in 2016 to just $2.3 billion by 2024. But from the moment the ban was issued, that number officially dropped to zero. Professor Zhao Zhang of Peking University observed that this was a meticulously calculated move, designed to apply maximum financial pressure on Washington without engaging in direct confrontation. A capital chokehold, disguised as administrative governance. A silent warning, echoing deep within the structure of America's financial system. However, what's worrying observers even more isn't that the capital flow has been cut off. It's where that capital is going now. And it's this quiet redirection, not the freeze, that's shaking the very foundations of the global financial order. As Chinese capital pulled out of US markets, the first thing people noticed was the silence. No alarms, no emergency meetings at the United Nations. But beneath that calm surface, a new current was quietly reshaping the global financial map. In December 2024, China quietly dumped $14 billion worth of US Treasury bonds, a figure that might seem modest but marked the largest sell-off in nearly a decade. It wasn't a random move. China's total holdings of US debt had now dropped to around $775 billion, the lowest level since 2009. A psychological threshold had been breached. At the same time, China's state-owned banks began restricting USD transactions with American financial institutions. A new financial network was being reconstructed, one where the dollar was gradually being removed from the center of China's most strategic dealings. U.S. Commerce Secretary Gina Raimondo admitted, "We are losing a critical advantage. China isn't just retreating, they're changing the game." And the consequences didn't wait to unfold slowly. In 2024, foreign direct investment into the U.S. dropped by 22%. Projections for 2025 show an even steeper decline, nearly 19%. The money that once went into expanding factories, creating jobs, and developing technology is now flowing elsewhere beyond America's reach. Investors who once bet on the stability of the US, like Japan's Government Pension Investment Fund, GPIF, and Norway's Sovereign Wealth Fund, began quietly pulling capital from sensitive sectors: tech stocks, commercial real estate, corporate bonds. A silent but steady exodus. Meanwhile, the US bond market is groaning under the weight of more than $4.1 trillion in debt coming due by the end of 2026. But the buyers, the whales who once filled the room, are now quietly getting up and walking away. This is no longer just a routine dip in investment. This is a slow liquidity chokehold, like a snake tightening its grip, gradually, deliberately, and without letting go. And while politicians are still busy arguing on television, American businesses, especially the small and mid-sized ones, are already feeling the pinch. In every project delayed, every payroll stressed, every unpaid invoice, the shortage is becoming painfully real. There is nothing more dangerous to a business than losing the belief that there will still be money tomorrow to keep going. When the flow of capital from China slowed, at first it stirred concern, but within just a few weeks, that concern turned into panic. This was especially true for small and mid-sized businesses, the ones that rely heavily on loans and international investment. The shock hit faster than anyone expected. Funding negotiations suddenly went silent. Partners who once eagerly signed deals now left behind nothing more than a polite rejection email. The doors to global capital markets closed, without warning, without sound. According to Bloomberg, in 2024, American companies were forced to issue over $430 billion in junk bonds, a 38% increase from the previous year. The average interest rate climbed to 9.6%, nearly double what it was 2 years earlier. This was no longer just a financial cost, it was a survival burden. Hartwell Tech, a mid-sized tech firm in Boston, became a textbook case. They had secured a $180 million investment commitment from a Chinese fund, but just 1 week after the ban was issued, every agreement was canceled. With no other options, Hartwell turned to Apollo Global, taking out an emergency loan at 11.3% interest, secured by all their real estate and patent ownership. Fitch Ratings warned that 1 in every 5 mid-sized companies is at risk of losing access to refinancing within the next 18 months, meaning no money to pay off old debts and no capital to start anew. In this environment, many businesses are trapped in a painful dilemma: either sell cheap to survive or hold on to pride and await bankruptcy. Some try to hang on by cutting staff, halting R&D, selling off strategic assets. But the cost of holding out can sometimes be even greater than collapse. Amid that despair, a glimmer of hope had once been lit. A familiar slogan: "Bring manufacturing back to America." A dream full of energy as Donald Trump returned to the White House and signed a wave of executive orders supporting domestic businesses. But then, as people began trying to make that dream real, they faced a cold truth. Without capital, even the boldest dream is just that, a dream. Bring manufacturing back to America. That slogan once rang out like a promise of an industrial renaissance, a vision of humming factories and jobs returning to the working class left behind. Donald Trump didn't just talk, he acted. Just weeks after taking office in 2025, he signed a flurry of executive orders, tax incentives, regulatory rollbacks, and streamlined permitting processes for companies investing in domestic production. On the policy front, America was ready. Financially, it wasn't. According to the National Association of Manufacturers, 62% of manufacturing expansion projects in the US in 2025 are suffering from severe funding shortages. Not because of a lack of ideas, not because there's no market, but because of a lack of capital, especially international capital, which had once fueled major industrial shifts. A wave of projects had no choice but to halt. An $8 billion battery plant in Michigan abandoned mid-construction. A $3.1 billion robotics center in Nevada temporarily shut down. Phase 2 of the $20 billion Intel Ohio megaproject abruptly postponed indefinitely. Economist Eswar Prasad calls it a sovereignty paradox, a nation striving for production independence yet unable to finance itself. Costs are rising, supply chains remain incomplete, and funding keeps slipping out of reach. What were meant to be engines of resilience have become hollow symbols, more media headline than momentum. And while the factories remain quiet, outside their gates, ordinary Americans are starting to feel the storm drawing closer. Not from the news, but from the everyday goods they buy, now, more expensive, less available, and harder to choose than ever before. In every economic crisis, the first and hardest hit is always the consumer. And this time, they're not seeing inflation in reports, they're feeling it directly in every essential purchase. Since the Trump administration reimposed steep tariffs on Chinese goods, pushing the average rate up to 22% on over $500 billion worth of imports, rising prices have become part of daily life. A washing machine, a replacement processor, a new iPhone, all of it now just a bit more out of reach. According to the U.S. Bureau of Labor Statistics, in just 1 year, the price of household appliances jumped by 16.7%. Auto parts, electronics, and other home goods have all followed suit. Retail giants Walmart and Target both issued warnings of profit drops due to surging input costs. The National Retail Federation estimates that the average American household is now spending nearly $2,000 more per year just to maintain the same standard of living. Meanwhile, real wages have barely moved. Inflation hovers at 3.6%, while spending power continues to shrink. Worse still, businesses, already stretched thin from lack of investment, no longer have the capacity to absorb these rising costs. And so, the vicious cycle begins. Companies raise prices, consumers tighten their belts, and the market slows, beat by beat. But what's keeping Washington up at night isn't just the rising cost of goods, it's something far more corrosive, quietly eating away from within. Trust. Trust is an invisible asset, yet it holds the power to steer an entire economy. And when that trust begins to falter, every other metric, from GDP to employment, becomes fragile. In Q1 of 2025, the Baker-Bloom-Davis Economic Policy Uncertainty Index hit its highest level in over a decade, surpassing even the peaks of the COVID-19 pandemic and the 2008 financial crisis. Not because of a single event, but due to the accumulation of many: tightened monetary policy, chaotic fiscal measures, inconsistent tariffs, and unpredictable sanctions. Businesses are confused and investors are directionless. The U.S. CEO Confidence Index, surveyed by the Conference Board, dropped to just 37 points, its lowest since mid-2020. That number doesn't just signal concern, it's a clear declaration that America's business leaders are walking in the dark, without a map, without a compass. Bloomberg reported that in the first 3 months of the year, over $120 billion was pulled from U.S. equity ETFs. This wasn't strategic repositioning, it was a reflexive response to disorder. No one is pulling out because they hate America. They're pulling out because they no longer know what lies ahead. And that is more dangerous than any sanction, because it strips the market of its most vital foundation: predictable stability. And as even domestic investors begin to waver across the ocean, America's long-standing allies are quietly starting to search for new paths of their own. There was no need for a grand press conference, no dramatic announcement on national television. But the signals from Berlin, Paris, and Riyadh were clear enough. America's allies are slowly shifting course, quietly, yet decisively. The German chancellor had just concluded a high-level visit to Beijing. Immediately after, BASF, a cornerstone of European industry, announced the expansion of its $10 billion project, not in the US, not in Mexico, but in China, the very country where Washington's tensions are rising. In France, a multi-billion euro liquefied gas deal was just signed, but this time it wasn't priced in US dollars, it was priced in yuan. Meanwhile, Saudi Arabia, once a rock-solid pillar of the Middle Eastern Financial Alliance, quietly pulled $27 billion from U.S. Treasury bonds, redirecting it into an AI investment fund co-run with China and Singapore. The president of the European Central Bank made a pointed remark: America hasn't lost its soft power, but it is fading. No one is turning away out of anger. They're simply hedging against a future where Washington's financial umbrella may no longer offer the protection it once did. While the world continues to debate whether China is retreating from the US market, in Shanghai, Shenzhen, and Beijing, a very different campaign is unfolding. This isn't a withdrawal, it's a repositioning. In just the first quarter of 2025, 38 Chinese companies went public through IPOs, a surge of over 50% compared to the same period last year. The capital isn't disappearing, it's being reinvested into strategic domestic sectors, core technology, clean energy, and artificial intelligence. Beijing isn't pulling money back to lock it away, it's using it to rebuild its own financial foundation, independent from the Western system. China's sovereign wealth funds have simultaneously increased their holdings in ASEAN bonds by $19.4 billion, a clear pivot towards Southeast Asia. The digital yuan has quietly expanded its reach, now integrated into cross-border payment systems in 13 countries, without needing to be converted into US dollars. Beijing isn't trying to bring down the old order, it's simply and silently building a new one, where the dollar is no longer the only choice and no longer the unquestioned symbol of power. We might call this a capital realignment, a natural shift in international relations, or even a reasonable defensive move from Beijing. But what if all of this isn't just a temporary reaction? What if it's the opening move in a long-term campaign, where China doesn't strike directly, but simply nudges America's allies away from using the US dollar? If that's the case, then this is no longer a battle over tariffs, technology, or capital. It's the final showdown to rewrite the formula of global finance. And if the US dollar is no longer at the center, then everything, from interest rates to debt to the value of your savings, could be changed forever. And by the time Wall Street finally looks up and realizes what's happening, the money may already be long gone, with no plans of ever coming back. If you want to keep up with deep analysis, accurate updates, and the untold stories behind global financial decisions, don't forget to subscribe to the channel, because only by understanding can we stop being caught off guard.